Green infrastructure capital is piling up faster than it deploys. Something unusual is happening in the green finance market right now, and it's worth understanding clearly. There is more capital allocated to climate-aligned infrastructure than at any point in the history of green finance. And yet, across the infrastructure landscape, from clean energy transmission to water systems to industrial decarbonization assets, the pipeline of shovel-ready projects is not keeping up with what investors have to deploy. According to Climate Bonds Initiative, 2024 aligned green bond volume reached approximately $671.7 billion, marking a 9.4% year-over-year increase. Institutional investors, sovereign wealth funds, and development finance institutions have committed unprecedented allocations to climate-aligned assets. ESG-labeled infrastructure funds are sitting on significant dry powder, but the bottlenecks are growing faster than the workarounds. For executives making infrastructure decisions in 2026, this gap carries real implications, most of which aren't visible from the outside of the market. Why the money isn't moving. The bottlenecks are structural. They aren't financial. Permitting timelines are the most persistent obstacle. A utility-scale clean energy project in the United States currently takes an average of 5 years to navigate federal, state, and local permitting processes, according to data from Lawrence Berkeley National Laboratory. That timeline hasn't meaningfully improved, despite years of policy attention and legislative intent. Projects that are financially sound are sitting in regulatory queues, while committed capital waits beside them. Grid interconnection compounds the problem. The queue for new electricity generation projects seeking connection to the U.S. grid has grown to over 20,600 gigawatts, more than double the entire current installed capacity of the American power system. Despite the massive volume, roughly 80% of projects that apply for interconnection are ultimately withdrawn. Capital committed to projects stuck in the interconnection backlog isn't productive capital. It's stranded time. Labor is the third structural constraint, and the most underappreciated. The skilled trades required to actually build large infrastructure: electricians, ironworkers, pipe fitters, grid technicians. They are in a structural shortage that the Infrastructure Investment and Jobs Act and the Inflation Reduction Act together made significantly worse by generating demand the workforce simply cannot currently meet. Projects are being delayed, not because of financing gaps or permitting failures, but because the crews to build them don't exist in sufficient numbers. That's a harder problem to solve than a regulatory one. What happens when capital can't deploy? Capital markets don't hold in place indefinitely. When green investment funds can't deploy at the pace their mandates require, the market finds its own equilibrium. And it isn't always the one climate transition advocates would choose. Some capital migrates toward lower complexity projects, energy efficiency retrofits, fleet electrification programs, smaller distributed generation assets, building systems upgrades. These are real investments with real impact, but they don't address the large-scale transmission, grid, water, and industrial decarbonization infrastructure that the long-term transition actually requires. Capital finding its way to the easier assets is not the same as capital solving the hard infrastructure problem. Some capital reprices risk. Projects that would have attracted favorable financing terms 3 years ago are financing differently now, not because the underlying assets changed, but because longer timelines and higher execution risk have worked their way into interest rate spreads and deal structures. The window of favorable terms for climate infrastructure is real. It is not unlimited. And some capital simply waits, which creates its own cost at a moment when every delayed year of infrastructure build-out pushes decarbonization timelines further from the targets they're designed to meet. What this means for capital planning in 2026. For executives trying to position their organizations to access available capital when conditions allow, the bottleneck environment creates a specific and concrete set of decisions. The organizations best positioned to capture green capital are the ones that have already completed the pre-development work: environmental impact assessments, preliminary permitting applications, land rights, interconnection filings, preliminary labor agreements. None of this is glamorous. None of it is financeable in the traditional sense. but it is what separates being ready to close a deal from being 2 years away from ready when the opportunity arrives. Additionally, the permitting and interconnection timelines mean that projects beginning pre development work today are realistically targeting operational dates in the 2029 to 2031 range. Capital planning horizons need to reflect that reality, not the optimistic scenario that appeared in project underwriting from prior cycles. Further, the labor constraint has become significant enough that leading project developers are now locking in EPC contractors and skilled labor agreements before financing closes, reversing the traditional sequencing. Organizations that haven't begun those conversations are entering the queue behind the ones who have. Water infrastructure, the quietest gap in green finance. The capital deployment mismatch is particularly acute in water infrastructure, and it's worth naming directly because the market underreports it relative to energy. The American Society of Civil Engineers, ASCE, estimates the U.S. water infrastructure investment gap at over $600 billion through 2030, with potential for $2 trillion in cumulative capital needs by 2043. Green bonds are beginning to reach parts of this. Water revenue bonds, blue bonds, utility sustainability financing, but the project development infrastructure is even less mature than in energy. Most water utilities lack the internal capacity to structure green financing at scale. The result is a pool of willing capital that can't find qualified, ready projects to fund. As environmental compliance requirements tighten through 2026, particularly around PFAS remediation, lead service line replacement, and stormwater management, the pressure on water infrastructure will intensify significantly. Organizations with water-related infrastructure exposure who are thinking about that exposure now, rather than when a compliance deadline surfaces, will have materially more options than those who aren't. The window is real. Preparation isn't optional. The green finance capital availability is not a permanent market condition. Interest rate environments shift. Political dynamics affect policy. Investor mandates evolve. The window during which infrastructure projects can consistently access favorable climate-aligned capital is open now, but accessing it requires project readiness that takes years, not quarters, to build. The organizations positioned to move in this environment are the ones that started their pre-development work 18 to 24 months ago. That's not a reason for paralysis, it's a reason for urgency. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.